Welcome back to Alpha Recap. I'm glad you could join us. Markets were closed Friday for the July 4th holiday, so today we're walking through the headlines that printed through Thursday, July 2nd. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks for having me. Lots to unpack. Geopolitics, index rebalances, semiconductors, and a tidal wave of microcap volatility. Pretty eventful tape heading into the long weekend.
Let's start with the big picture themes so listeners have a roadmap. The three big threads were an intelligence office shakeup that bumped event risk for defense contractors, an S&P reshuffle that forced passive flows, and an extraordinary cluster of penny and small cap spikes and collapses driven by heavy retail volume. Sound right?
Yeah, that tracks. And under each umbrella, there were concrete market actions that mattered for liquidity and risk heading into Monday.
Okay, first theme. The acting director of national intelligence fired dozens of officials. Analysts called this a classic event risk trigger for defense names. Walk us through why that mattered to the tape.
So, what really stands out here is the cascading effect. When leadership at the Office of the Director of National Intelligence changes abruptly, it can raise questions about oversight, contract timing, and audits. That lifts short-term political risk for defense contractors like Lockheed Martin, Northrop Grumman, and General Dynamics.
Right. And I noticed coverage pointing out that Lockheed Martin was being talked about as a dividend income alternative with a yield around 2.75% and a long history of raises. How does that play into the headline risk?
Analysts note the tension here. Income-seeking buyers may view higher-yielding contractors as defensive, which can support price floors. At the same time, event risk can compress multiples and increase volatility. So flows can go both ways. Some buyers rotate in, others de-risk and sell.
So the practical action item was to check contract calendars and model sensitivity to policy shifts. Simple, but important.
Exactly. Run conservative scenario checks on order book and contract timing exposure, and rerun discount rate sensitivity and valuation models to reflect higher near-term policy risk.
Quick reactions, short and sharp? Got it. Moving on, index rebalances. Conagra Brands was removed from the S&P 500. That created some forced flows, right?
Right. And the other thing is that mechanical selling by S&P tracking funds usually follows removals. The report noted Conagra was at about $14.34, and S&P trackers generally sold into that process, while smaller cap funds may have added exposure. That changes bid-ask dynamics for the stock.
There was also a note that many starter accounts defaulted into a low-cost S&P product. The article mentioned the dominance of that passive path for small balances.
Yeah, analysts highlighted defaults into an S&P product for starter accounts. Over decades, fee differentials matter materially for small balances. So those defaults reinforce steady retail inflows into broad S&P exposure, even as individual names get shuffled.
Short reaction segment.
Makes sense.
Now let's shift to semiconductors and ETF signals. NVIDIA posted a modest decline, about 1.5% to roughly $195 on heavy volume, and an inverse leveraged semiconductor ETF jumped about 17% on enormous volume.
And that combination is telling. NVIDIA is a bellwether for AI and chip-linked names, so a heavy volume dip can ripple broadly. Meanwhile, that inverse ETF spiking on about 918 million shares suggests significant short or hedge activity. Traders positioning for sector stress or rotation.
So the tape looked like hedging and short covering in play. What should traders have been watching for when markets reopen?
Practically, you could expect higher option implied volatility around semiconductor names. Analysts were going to watch the opening price for NVIDIA and intraday option volatility moves for signs sellers or hedgers remained active. Also, flows into both long and inverse sector ETFs can accelerate moves in underlying stocks.
Short reaction.
Higher vols, yep.
Now the biggest and craziest theme. Microcap surges and crashes. There were dozens of triple-digit percentage moves in sub-dollar and low-price names, plus some enormous volume poppers in small caps. Give us the layperson explanation for why this was so extreme.
I mean, when you step back and look at this, two things were happening. First, genuine volume-confirmed surges with hundreds of millions of shares. Think one stock up about 100% to $6.48 on roughly 83 million shares. Or another up about 90% on about 330 million shares. Those read as momentum chasing or short covering. Second, several names showed anomalous prints or ultra-thin liquidity, zero price closes, odd data feed entries, which are susceptible to quote stuffing or single block trades.
That data inconsistency point is crucial. The briefing flagged 0 price prints and 0.00 fields. People should have verified across feeds before acting.
Exactly. When you see names with bizarre prints, double-check regulatory filings like 8Ks and press releases for catalysts, and confirm quotes across multiple data providers. Slippage and execution risk were front and center.
The microcap roller coaster, always wild. Quick reactions.
Honestly, I was a bit surprised by this one.
Let's give listeners practical risk takeaways from that microcap madness.
Risk managers should treat many of these moves as speculative. Use tight position sizing and liquidity tiers. Even small absolute exposure can swing a portfolio massively when moves exceed 50 to 100%. Also, verify 8Ks, SEC filings, and press releases. Expect regulatory trading halts or clarifications for names with the most anomalous prints.
Good, concrete stuff. Moving on to retail and consumer notes. The briefing had a MarketWatch reader anecdote about an older in-store workforce at a major retailer, and a separate point about premium lounges from card issuers expanding beyond airports.
Right. The retailer anecdote raised micro-level staffing and wage questions that can affect local margins and same-store sales trends. And the card issuers, American Express and a big bank, are broadening premium lounge access into festivals and sports venues, which is a revenue and engagement play that monetizes experiences beyond travel.
So one is labor and margin pressure at the store level. The other is monetizing premium experiences. Both are strategic revenue diversifiers.
Precisely. Watch for company commentary or partnership announcements that quantify the opportunity.
Let's pull back now. Market signal summary in plain language.
We saw 3 emerging trends. 1, retail-driven momentum in low-priced names came back strong, with lots of heavy volume spikes. 2, structural passive flows from index rebalances and defaults into S&P products continue to shape liquidity across market caps. 3, event risk, that intelligence office shakeup, can quickly create sector-specific repricing in defense names.
Also worth noting that leveraged and inverse ETF moves alongside a bellwether dip hinted at hedging and short positioning that amplified sector volatility.
Yes, ETF and derivative skew matters. Big moves in inverse leverage ETFs can be a canary for intrasector stress.
All right, what should listeners watch when markets reopened Monday, July 6th?
Follow-through volume on the biggest movers is key. Sustained volume will separate headline-driven moves from one-off spikes. Also, check 8Ks and press releases for microcap names that surged without clear catalysts. For defense, look for any statements from the intelligence office or congressional reaction that could affect contract continuity. And in semiconductors, watch NVIDIA's open, option-implied volatility and flows into sector ETFs.
And remember to verify quotes across data providers for names with odd prints. That was a big red flag in the briefing.
Right. Execution and liquidity risk were emphasized. If you saw a zero price close or inconsistent feeds, don't assume that's tradable.
Quick reaction segment.
Worth repeating.
Before we wrap, a short reminder on the investment stance here.
This briefing was informational only. It didn't recommend buying, selling, or holding any security. Analysts note patterns in data. Listeners should verify filings and use risk management techniques when assessing exposure.
Final takeaways in 3 bullets.
1. Event risk from the intelligence office shakeup elevated volatility for defense contractors and merits model sensitivity checks. 2. Index rebalances and defaults into S&P products forced mechanical flows that can amplify moves in thinly traded stocks. 3. Microcap activity was extreme. Verify catalysts, expect high slippage, and prioritize liquidity control.
Solid. If listeners want a short checklist for Monday, monitor follow-through volume, check 8Ks and press releases, watch NVIDIA and semiconductor ETF flows, and verify quotes for any names with anomalous prints.
Yep, and remember, use conservative position sizing when dealing with low float names.
Okay, that's it for today. If you have questions about anything we covered, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening to Alpha Recap.